Okay, good morning and welcome back, everyone, to our weekly Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are resuming these sessions with a very different view of the markets from last week. Last week we were on the verge of potentially turning negative or turning, far more bearish than we are this week. One of the probably most important things that bulls have managed to do over the past week or so is to reclaim the 50-day moving average on the S&P 500 as well as on the NASDAQ 100. So both major indices managed to get back above a major resistance level and resume their bullish trends. Now we're not quite back towards our 52-week high yet on both the S&P and the NASDAQ. That's our short-term upside target. And we really want to see both indices exceed that all-time high in order to truly confirm a bull market here. But we are looking substantially better in terms of outlook here between both indices. You have the small caps, which is still below the 50-day moving average, but this is really where I do anticipate potentially some catch up here from small caps, some of the underperforming sectors and areas of the market to catch up. Small caps certainly one of those particular areas, as well as equal weight S&P 500, as you can see, just at the verge of that 50-day moving average, reclaiming that 50-day moving average. So, you know, um, especially if we can see small caps and equal weight get back above those 50-day moving averages, that would be a far more better signal on the confirmation of kind of the continuation of the bull market. And if we can get back to those all-time high levels and break out higher, that would be an even better confirmation for the bull market that we're currently in. So a big turnaround here in the past week or so, as you can see, value outperforming growth by a pretty significant margin here over the last week or so. My expectation is that we're going to see a bit more of that as kind of small caps and value names play a little bit of catch up here over the past week or so. We've seen commodities continue to take off here, gold and oil strength. Both gold and oil starting to test some major resistance levels. So you could see a bit of a pause here in terms of the rally here for commodities, especially if equity starts to take off here. But HYG, high yield corporate bonds, back near all-time highs, really potentially giving us a more another confirmation here on the risk on market here for risk assets. You have the VIX retreating back below 16%, showing kind of fear receding a little bit from the markets. And you have Treasury yields also coming down substantially from where we were a week ago. Still elevated, but still above 4.6%, but certainly looking a lot better in terms of yields, providing a bit of headwind here for equities in the short run. You have seen bond sell-off kind of stem that sell off here a little bit. You have a short-term rally, not enough, in my opinion, of a rally to suggest that the sell-off in bonds are over, but at least in the short run, providing a little bit of relief here for equities. You have the dollar index now below 109, really kind of speaking to the fact that the move here to the upside for the dollar is looking fairly exhausted. And I think a pullback to that 50-day moving average is more likely here in the short run. You have Bitcoin obviously rallying quite a bit here into that 104 area, $104,000 in terms of Bitcoin, making a run at the all-time highs. We really want to see that breakout here above those all-time highs to continue that bullish tone here for Bitcoin. But with the new Trump administration kind of embracing cryptocurrencies as an asset class, I think you have a higher likelihood of that breakout above those all-time highs and continuing with the support of that administration. As you can see, gold is back kind of at those recent highs here around 2,700. We're looking for that breakout here above 2,700 to confirm that double top breakout and see further strength here for commodities. But we are trading up against some major resistance levels, which is what could pause the rally here. Same thing in oil. Um, we saw some of the incoming administration's policies be favorable in terms of output for oil, and that I think in the short run will likely provide a bit of pullback here for oil, for energy prices in the short run at that double top level around that $78 level for West Texas Intermediate. And then if you look at the individual sectors here, I think of note, technology lagging behind, but playing a little bit of catch up here right now. Consumer discretionary resuming its kind of bullish trend here, one of the few sectors that remain above the 50-day moving average and continuing to be above that level. Communications, as you can see, still kind of hovering below that 50-day moving average here right now, starting to underperform here a little bit relative to the S&P 500 financials. Also breaking back above that 50-day moving average and starting to show some strength here. So financials looking quite strong at the moment. Um, Consumer discretionary, as you can see, continues to underperform the S&P 500 by a pretty significant margin. Healthcare underperforming the S&P 500 by a pretty significant margin, continuing to do so. Materials underperforming, playing a little bit of catch up here over the past week. We'll see if that catch up can continue, or if we kind of get to that 50-day moving average and start to bounce off here and continue that underperformance here, because materials have underperformed the S&P 500 by a pretty significant margin. Industrial, same thing. We've seen that underperformance here, but by a pretty significant margin, but recently played quite a bit of catch up. But my concern is that the long-term underperformance is likely still going to be a factor here for industrials. Real estate played a bit of catch up here with yields falling, but yields remain fairly elevated, and I'm concerned that real estate has some further downside here, given the fact that yields remain relatively elevated. Energy, big rally here in energy over the past couple of months, but I expect that's going to take a bit of a pullback here, especially if oil prices start to pull back a little bit here over the next couple of weeks. Um, and that's kind of the base case that we have here right now. Utilities are rallying quite a bit here also on the back of lowering yields. That can provide a little bit of support here if we find yields back below 4.6% on the 10-year over the next couple of weeks. Home builders, one of the big outperformance here over the last week or so as a result of the yields that we've seen, the decline in yields. So big beneficiary of that, and we expect that that will likely be one of the sectors that underperforms in the short run, in the long run, at the moment still because of those higher yields, even though in the short run we're seeing a lot of outperformance. And then semiconductors. We've seen semiconductors underperform the S&P 500 by a pretty significant margin, but over the past, I would say month and a half, we started to see a little bit of what looks like outperformance here. And this is really where I do think that, if we look at semiconductor stocks, you see quite a few that look like they're on the verge of breaking out here. And when you see that coupled with some outperformance here, there's a suggestion that we could start to see some outperformance here for semiconductors going forward. So that is one sector that I think um, not on everyone's radars here because of how long they've underperformed here over the past 6 months or so. But I think showing some early signs of positivity here at the moment. So that's kind of where we stand from a macro perspective. If you take a look at some of the stocks that we currently have bullish or bearish view on, here are some of the ones that I think are worth paying attention to. Apple trading at 32 times forward earnings, I think has some further downside here going forward. We just saw the news out of Apple China sales losing a significant amount of ground here in China in December here. Instead of being the top smartphone seller in China, they're now number 3, which is a pretty significant change in such a short period of time. Um, And Apple reports earnings in less than 2 weeks, and I think that could be an earnings announcement that could provide some disappointment here. So Apple, I think, be wary, be careful. I think there's some potential further downside here. Arista Networks, we kind of talked to you guys about this when it was starting to break out here above 115. We're starting to see that breakout here and kind of continuing above 115. As you can see, it's outperforming the S&P 500 as it breaks out. This is really where I think there's some significant upside here for Arista Networks. Boeing. Boeing, as you can see, kind of after breaking out here to the upside, pulling back here. This is really kind of where the setup is for potential further upside here. You have a new CEO that's coming in that's far more hands-on. He's moved out to Seattle. He's uh, figured out the labor disputes. He's gotten new funding. They're working on improving deliveries on the 737 and 787 programs and getting the 777 programs on track here for the 777X. And it just seems like they're doing some things right finally for the first time. And this is really where I think the opportunity looks most favorable in terms of risk reward for investors to the upside in a long time. So that's why I think Boeing, trading at about 1.4 times sales, looks a lot more attractive than most other names in the aerospace industry, especially if you look at expected EPS and revenue growth numbers here. Boeing, by far the cheapest in the aerospace industry, I think finally turning a corner here in their multi-year kind of decline. So I think worth taking a look at for investors. CME, not a stock that's on most investors' radars. They operate the world's largest futures exchange. As you can see, broke out here above 225, came back and retest this as support. And that's really kind of where I think the upside opportunity lies. CME, most people don't realize, but their net margins are over 50%. So for every $1 they generate in revenue, they generate over 50 cents in profits. And so very, very profitable company and trading at a very reasonable valuation given how profitable they are. And I think this is really where I think there's some further upside here for CME Group. Disney, we started liking Disney when it was in the $90 range here, when it was kind of bottoming out. It kind of broke out here above those levels, started to break out higher here. And now we're kind of coming back to retest some major support levels. And this is where, if you're not already long Disney, I think this is really where the opportunities to kind of get long is in this low $100 range. And the risk reward ratio looks fairly attractive here. If we get down into that 103 level, that would be a major support level for Disney to potentially spring off of and continue higher from where we are. Dexcom, we started talking about this breakout here above 80 after kind of forming this major bottoming formation here. And we're looking like we're finally starting to break out here to the upside. And our upside target here is around 110, which is kind of filling that gap here. So pretty nice upside potential here for Dexcom. Ecolab, this is one that we have a bearish view on here. As you can see, it recently broke below 240, broke below that level, came back to retest this level as resistance. And this is really where the risk reward ratio looks most favorable for a bearish view. Our downside target here is around 220 here to the downside. So you have about another $20 more to the downside in potential profits for Ecolab. I'm trading at about 30 times forward earnings. It's about 50% premium in terms of valuation relative to its peers, even though it's barely growing any faster and is not any more profitable than its peers, but it trades at a very high valuation relative to its peers. And that's really why we have a bearish view here on Ecolab. Alphabet, one of the few major tech names that are trading just around 20 times forward earnings, which if you look at kind of expected growth rates, net margins of close to 30%, no major tech name is trading at valuations at 20 times forward earnings. And the fact that it recently broke out above this 190 all-time high and formed a base, that's really the base that it can potentially continue higher from there. And notice how it outperforms the S&P 500 over the past couple of months, as it breaks out to those new all-time highs. That really provides the evidence for potential further upside in addition to the extremely cheap valuation that Alphabet trades at relative to the other tech names. Lululemon trading at only 22 times forward earnings is an interesting play here in the consumer discretionary space. Far more profitable than its peers, grows fast, grows roughly in line with its peers, but the fact that it's far more profitable is really what justifies the premium valuation that it could trade at, even though it's trading in line with the rest of the market here. So our upside target here for Lululemon is in that 470 range or so. So we still have potentially another $100 or so here to the upside for Lululemon. Meta, another one in the tech names that trades at what I consider as a very discounted valuation of about 24 times forward earnings. Meta's net margins are 35%, which is what makes it most attractive in my opinion. Growth metrics that are in the high single digits. I'm sorry, high double digits. In the high teens in terms of expected growth rate, but 35% net margins is really what uh, allows it to trade at a more premium valuation, even though right now it only trades at just it actually trades below industry averages in terms of valuation. The industry average is around 27, Meta's around 24. So even if it just trades in line with the rest of the industry, you still have about 15% upside in the stock. But given the 35% net margins, I think this is a stock that should be trading closer to probably around 30 times forward earnings. So, that means you have another close to 30% upside here in the stock's share price. So, Meta representing what I believe is a fairly attractive opportunity here within major tech names, if that's a sector that you like investing in. Netflix, on the other hand, I think starting to look more and more at risk here, as you can see. After what has been a very strong year, starting to look like a bit of a topping formation is starting to form here, right? However, you want to draw your lines, whether you want to think about this as a head and shoulders, or it doesn't really matter what pattern you prefer. But what you have here is this 875 level that has provided prior support that has now been broken and now retesting as resistance and potentially resuming further downside here. And notice how while Netflix outperformed the S&P 500 over the past month or so, has really started to underperform the S&P 500 and showing some weakness here going into earnings. And that's never a good sign. And that's really where I think you could see some further downside ahead, and earnings could be the catalyst that drives Netflix lower. NVIDIA, I think represents one of the best um, value opportunities right now. And it's hard to say that when something's trading at 30 times forward earnings. But if you look at growth metrics, you're talking about the top and bottom line growth expectations that are in the 50+%, right? So revenue and EPS growth in the 50 plus year over year range, unheard of in the tech industry, in the mega cap tech industry world right now. And then on top of that, kind of the cherry on top is the fact that NVIDIA's net margins are 55%. So some of the highest net margins you see in the entire S&P 500. So because of that, it actually trades at a valuation that's cheaper than Apple. Apple trades at 32 times forward earnings, and that really kind of speaks to how much, NVIDIA looks undervalued and how overvalued Apple looks, next to each other as businesses. One grows substantially faster and is substantially more profitable. The other one is clearly showing some declines in terms of growth, some deceleration in terms of growth, and net margins that are less than half of what Nvidia's are. Yet Apple trades at a valuation that's more expensive than Nvidia, and that's why I think being long Nvidia and short Apple, I think, is probably the best pairs trade right now within tech at the moment. Um, Pepsi, this is one that I wanted to take a look at here because Pepsi is so severe, so severely oversold here over the past nearly 6 months or so, basically start since the beginning of August. Uh, we've seen a severe underperformance of Pepsi relative to the market, even though if you look at revenues and profits, very much kind of steady throughout this entire time. So this is really where I think this is where the stock price has decoupled a little bit from the fundamentals and gotten a little bit oversold. And I think this is really where you have a bit of a bounce opportunity here on Pepsi trading at right now only 16 times forward earnings is trading at a pretty substantial discount relative to the industry and represents, I think, so a catch-up opportunity right now as markets kind of show a little bit of strength here. Shopify, we started looking at Shopify when it was around $70 here or so. It's rallied quite a bit since then, and since it gapped higher here, it's starting to pull back here into the kind of the low 100s, and this is really where any further weakness here in this kind of into that 90 $92 range provides a really nice risk reward for some further upside here for Shopify if you don't already have a long position here in Shopify. So timing on this, I think if you don't already have a position, if you could be a little bit more patient and see if this pulls back a little bit more, that's really where I think is your most optimal entry here for Shopify. Shopify trading at a pretty, um, uh, I would say, elevated. It's starting to trade at a more elevated valuation here at the moment because of the growth that we've seen here over the past year or so. But this is really one where I think there's still some substantial upside given how fast Shopify is growing here right now and the potential in terms of stealing market share away from e-commerce mega sites like Amazon and Walmart. Square, or what we now know as Block, um, payment processor, uh, showing a fair amount of strength here since we started adding this to this position in like the high 60s or so. It's got a really nice move here, but what's really I think attractive for a lot of investors is that it's recently pulled back substantially to some major support levels here around $80, and starting to bounce off here, and that's really where I think the upside potential or the risk reward potential at the moment looks fairly attractive here right now. Our upside target here is well into, above $100, closer to 150 because Square trades at only 17 times forward earnings. It's extremely, it grows extremely fast. It's still working on profitability right now. And that's really kind of, if we can see margins expand for Square, that would probably be the biggest driver of, upside appreciation for the stock. Take two, this is one that we have a more bearish view on here right now because we've seen a fair amount of revenue decline here for Take Two, yet it's still trying to hang on to these kind of 52-week highs. But this is really where I think that there's a downside potential here for Take Two. It trades at a premium valuation relative to the industry, and I think it's names like this where we're starting to see some revenue decline and rich valuations that, have the biggest risk here to the downside this particular earnings season. And then lastly, Visa. We really like Visa here to the upside for obvious reasons in terms of, global economies moving to more digital payments away from cash. Visa is the 800-pound gorilla in the room with regards to digital payments and cross-border payments. Um, this is really kind of where the upside, in my opinion, remains. You have Visa trading at around 27 times forward earnings, even though net margins are north of, 50%. And that's really kind of represents the upside potential here. If you look at Visa compared to companies like Apple, the fact that it grows substantially faster, the fact that it's substantially more profitable against a tech giant like Apple, yet Apple trades at a higher valuation represents kind of the the dual opportunity, in my opinion, to be short big overvalued names like Apple and long undervalued stocks like Nvidia, Alphabet, Meta, Visa, these types of tech names I think are far better tech plays from a valuation perspective than Apple. So that rounds out kind of our full trade ideas list. And hopefully this gives you, these sessions give you a clear understanding of kind of the bigger picture from a macro perspective, and more importantly, gives you a bunch of trade ideas to start your week, both bullish and bearish ideas that are rooted in both technical and fundamental analysis that we've done kind of a deep amount of research on these specific names that we like from a trade idea and trade setup perspective. So we try to bring you fresh ideas every single week and make sure that you kind of have those to set up your trading week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.